So hi everyone, thanks again for joining us today, and thank you, Amanda, for speaking. It's great to have you back at another event. So Amanda Vella is a Senior Director, Business Advisor, and Transition Consultant with ATB Financial. Amanda is focused on providing tailored advice to clients on business valuation, value acceleration, effective exit strategies, and long-term financial preparation for a business transaction. Amanda has over 17 years of experience in finance leadership, business advisory, strategic and financial planning, corporate finance, and business valuations. Amanda is also a chartered accountant, chartered business evaluator, certified exit planning advisor, and a certified high performance coach. Thanks again for speaking today, and good luck.
Great, thanks for having me. So today I'm going to talk on value acceleration, and really my message is a transition-ready business is a valuable business, no matter where you are in your exit journey. So starting with a bit of a story as to really what got me into this space is working in valuations and M&A. I was seeing a lot of misinformation out there with business owners that, they really thought as soon as I'm ready to sell my business, I just put it on the market and it's okay. The good business owners were probably going to their accountants about 2 years in advance and making sure that they qualify for the small business deduction, maybe put the warehouse in a separate company, do some restructuring. But that was what it meant to get ready for a transaction. And unfortunately, what happens is so many business owners then go to market and their business doesn't sell. So I worked on one file that was the exact case. He had gone to his accountant to get ready 2 years in advance and then came to us to value the business and put it up for sale. And what happened is in the business, there was a lot of things that would scare a buyer away, including too much owner dependence. He was answering the phone all hour of the night. Really everything was dependent on him, and without him, the business probably wouldn't succeed. The other thing is he really didn't like having employees on staff. So he had all his employees, which were working in the office, as contractors. So this was some hidden tax liabilities that a buyer, may be exposed to. There's ways to work around that, but there was just, a number of things in the business that would give buyers some angst, and really in the end, scared most of the buyers away. And working for ATB Financial, particularly in their wealth group, this is concerning because 80% of wealth is often tied up in a business for business owners, that they put all their money in the business. And it's really concerning for our clientele because we know that a lot of them don't have plans in place, like many business owners, of how they're going to get that wealth of the business. And if something happens to that business owner in the meantime, it can really destroy all the wealth for the family. So I'm really glad we have this offering to try to protect the wealth that the business owners have in their business and really make sure that they have good succession plans in place. So yeah, that's me. I already had my introduction. So some facts as to why this is so important, because I found this staggering when I got into this space and really dived into it, that 91% of business owners realize that they need to have a succession plan, but yet only 21% have a formal plan in place. And I would say what I see, those that have a formal plan, it really hasn't been tested. So there's just a thought, I'll pass on to the family, I'll pass on to management, I'll just sell to a third party. I know, once I'm ready, it will just sell. So those are some of the assumptions they make. And unfortunately, especially the family one, it's surprising how many times those conversations aren't had within a family if the children are even interested in taking over the business. We also know that 75% of business owners regret selling their business within 1 year of exit. And this really is because for many business owners, the business is their baby and their identity is so tied up into that business that they feel a little lost. So, for the first year, maybe the golf, the extra time with the grandkids, all the things they wanted to do, fulfill them, but at some point that isn't enough. So it's really important when you go through this path to really think about what you're going to do after the business and make sure it will, help fulfill you in ways beyond just giving you more time in your day. And then only 20% of businesses that go to market actually sell. And the other part about this is that if your business is really unsellable, that many M&A advisors won't even take you on. So, your picture is cut just below your nose. Is that better? No. Oh, weird. Okay, let's go to my end. Okay. Yeah, so even though only, okay, good. Okay, only 20% of businesses sell, like I said, some advisors won't even take you on. So it's even less than that if you consider all the businesses. And then we also know that many businesses don't transact on the owner's timeline. Many are a consequence as a result of death, disability, dispute with shareholders, departure of a shareholder, a key member, or divorce. So if one of these things happen, and most times it's death that's the most catastrophic, or disability in the future of the business and protecting the family's wealth. So this isn't US stats, but we know that all the baby boomers are retiring and there is going to be a flood of businesses on the market. You might have heard the big wealth transfer, and I know it's been talked about for some time in this space. However, time is really ticking, and these baby boomers are getting older, and we haven't seen this flood of businesses exiting. So there are a lot of older business owners out there right now without these plans in place. And I would say post-COVID, like right now, even this summer, we're starting to see it heat up, and more business owners are thinking about this. So in the US, they estimate 250,000 businesses will be on the market or ready to transition or exit by 2030. And of that, only 50,000 will be deemed market ready. So that's what I talked about. Are they really in a position that they could sell and somebody else could step in and run the business? Still, of that, only 30,000 will actually transact. 16,000 will sell with concessions, and we're seeing a lot of that through COVID. If you haven't been able to normalize your COVID or prove that your results have gone back to pre-COVID levels, we're seeing a lot of earnouts and other things put into agreements to make sure that the risk is put back to the seller instead of the buyer assuming that risk. So concessions are really high right now. And then only 14,000 will sell at a desired price. So our hope is by doing some of this value acceleration work with our clients, and what I share with you today that you could do in your business, is that you move further down this triangle and increase the likelihood of a successful transaction. So what we use for our overall planning framework is we call it master planning, and it's a three-pronged stool. And the idea is that if you're missing any one of these pieces, you're probably not going to have the most successful transaction. And the first one that I will be focusing most of my time on today is maximizing the value of the business. And I know sometimes in family transitions or management transitions, that's not the number one goal, but it can also just mean getting the value out of the business that you desire. But you'll also see there's a lot of things you can do, years in advance to really drive up the value before you sell. The other piece is ensuring you're personally and financially prepared. And what this means is, have you sat down with your wealth advisor or another advisor to really do some cash flow forecasting post selling your business, and making sure that throughout retirement, or if you're going on to another career, that you're going to have the financial means you need to move on to that next phase of your life. And that means looking at everything like life insurance, the sale of your business, stock plans, taxes that's going to happen when you do this, any other costs, anything else you want to do in that next phase of your life. Maybe you want to pay for children's education, grandchildren's education. So it's a really wholesome view of all the cash you have going out and the cash you have coming in. And why this is so important is one of the things we see that causes transactions to fail is at the 11th hour, the business owner, I call them, they affectionately get squirrely. And some of that squirreliness is that they don't feel confident that they're getting enough money to live in the next phase of their life. So that's why we do that detailed planning, to try to make them feel calmer that if we get this amount for your business, we've done as best a modeling as we can that you will actually have enough to sustain the lifestyle you want post-exit. And then the last piece is that piece I talked about, that life after business planning. So when you do that life after business planning, it's really looking at what you want to do that fulfills you and gives you similar meaning in your life that the business did. So maybe it's not working as long as you worked in the business, but maybe it's working on a board as an advisor, or maybe it's volunteering, doing some charity work, just something that really understanding what the business gives you and what else you can do in your life that will fulfill you in the same way. So now moving on to maximizing the value of the business, which is the main topic, being a business valuator, that I want to talk about. And the model we use is value acceleration. And what this does is it really looks at the simple valuation model, which is, adjusting EBITDA or cash flow, whatever you want to call it, but basically taking out any one-time items, normalizing salaries for market rates, those type of things, and then multiplying it by a range of multiples to give you a value. Now that range of multiples is set by the market. You don't really control it, but for example, a business in your industry may go over 3 to 6 times EBITDA. So the market sets that, and it can vary based on market conditions. So if you were to do what most people do, if they do this work, they try to improve the EBITDA. So how can we get to more predictable and sustainable cash flows? How can we get to really clean cash flows, taking out those personal items, clean up the balance sheet, get rid of any redundant assets, things that really aren't used in the business, the personal items in the business, and how can we make the operations as efficient as possible? So you'll see a lot of procurement efforts. Just be careful of, I call it the slash and burn. So what some businesses try to do is really cut costs to the extreme right before a purchase, to inflate EBITDA, but most business owners will see, or most buyers will see past that and understand that, that's probably not sustainable in the long term, and they'll have to put some of those costs back in. So back to why doing this as far in advance as possible is great, because the longer you can show that you can operate in an efficient manner, the better chance you are to get value for that when you sell your business. But the other piece to really accelerate the value is, how do you improve where in that range of multiples the buyer will pay? And that's really a function of risk. So if the buyer is taking on a lot of risk, you're going to get a lower multiple. If the buyer has a really ready to go, we call it best in class business, that they're assuming very little risk, that they know it can operate without the owner in place, then you're likely to get a higher range of multiples. So this is the other area that we spend a lot of time with our clients, is how do we de-risk the business? Because if you improve both sides, you really accelerate the value. And what I'm really explaining here, EBITDA. So earnings before interest, tax, depreciation, and amortization. So it's really meant to get you back to a cash flow, or another way of thinking about it, how much cash is in your business. And you may have seen a C at the end. Sometimes they're throwing in COVID, but I would caution against that you're not necessarily going to get full value for COVID adjustments. In the beginning, we thought, okay, it's going to be a blip and then we'll go right back to normal. So, we know in some industries that the businesses have fundamentally changed because of COVID. So it's really trying to assess how much of your COVID impact is long-term and how much you expect to come back. So what I'm describing right now is really just great business strategy. So you can do this at any point in your business, which is why we suggest doing it at any point and having a business that's ready to sell, because that makes a valuable business. The other thing I'm seeing is more growth companies, before they go into that next stage of growth and really catapult their business, they want to make sure they have this solid foundation in place. So we're doing that work with some really high growth companies as well, to make sure that we're in a good state before we grow the business fast. So show the impact. So say you had $5 million in EBITDA or cash flow. And like I said, if we go back to that 3 to 6 times, so right now your business isn't in a great state, you're at the low end of the range, that's a $15 million valuation done simply. So we can improve EBITDA to $6 million, and we move you up even just 1 time. So you're not even best in class. Best in class would be 6 times. So we de-risk it a bit to get you up to a 4 times multiple. Now you're selling at a $24 million business. So that's a $9 million business, or 60% improvement. And what I really love showing this to wealth advisors, if we know that 80% of your assets are in the business or somewhere around there, we spend a lot of time on that other 20%, like your RSPs or your other investment portfolios. But look at the return we can get by working in the business. Like, this may be the better focus if we really want to, increase the value of your retirement plan. So the way we do this with our clients is we do that pricing analysis. So we work to come up with a normalized cash flow, and then that cash flow is based on owner readiness, and then we correlate where you fit in that range based on owner readiness and business attractiveness, which I'll get into what that means. But basically, we use that to help assess the risk in the business, to help further define where you fit in that range of multiples. And that's something that we can keep testing as we go through this to see if it's improved, and really work with management to have that as an internal KPI in their business. After we've done that assessment and we understand, maybe where you're not ready, where the business may not be attractive, we can start setting business goals and personal goals. So we create a real action plan as to how we're going to make things better. And then we really split on how do we work on the business and do it in 90-day sprints, because you still have a business to run, and the last thing we want is to take your eye off the ball from running the business. So we break it up in small chunks. And then also having a personal side. How do we make sure you get your wealth plan, your tax plan, your estate plan, that life after business plan in place? So we work on those in pieces. After we've done, all the low-hanging fruit or the big nuggets there, we're ready to exit the business if that's what the owner wants. But sometimes we find too that, we fixed a lot of the problems in the business, and now the business owner wants to stay in a little longer, and we can look at advanced value acceleration things. This could be a tuck-in acquisition, capital expenditures, anything like that might take some capital, and there may be some risk that it would take a little bit longer to pay off, that we may not want to put that in if there was going to be a quick sale. But if there's a longer sale, Those are some advanced strategies we can use to really accelerate the business and make sure you get the highest value. So when we talk about this, I think sometimes we always assume a business will go for a range of multiples. It's either the low end or the high end, but what sometimes gets missed in these conversations is that there are unsaleable businesses. Either the market's not looking for businesses in that space, the earnings are that terrible, or and in those cases, sometimes we're looking at liquidation value of the assets. We're seeing a lot of this right now, and I'm in Alberta, so oil and gas service companies in Alberta that are really struggling, but they still have some good assets that could be sold. So moving to more of an asset basis, or it could be what's known as a lifestyle business. So this is really where the business is the owner, and there's no possible way to move it on to somebody else. So maybe you see this a lot in consulting, and maybe you are the only consultant in the business. They're really hiring you to sell their business or you to help them with strategy. That somebody else buying that, they probably won't hire it. They're hiring the person. So if it can't be distinguished from the person, and there's no way to pass it on to somebody else, then that can be just a lifestyle business, and it's really not passable. Or we call it, you might also hear the term personal goodwill. It's all personal goodwill, which buyers won't pay for. So when we talk best in class business, so these are some of the things that you can rate yourself on and some ideas of things that you can do to make your business more saleable. It's really understanding what's next and where you want to go. That just helps the owner keep their head in the game throughout the transaction and not get that squirrely. Making sure you have proper tax planning. The next one is contingency plans. This is the one I see the most, is that I have older business clients that don't have a good plan in place. If something were to happen to them, who's going to run the business? Who's going to put that in place? Oftentimes, in a will or something, it may be the wife. Understanding that in that situation that they're emotionally distressed. Are they in a situation where they can run a business? So we like to see good personal directives. In the estate plans we do, and then a clear plan of how is this business going to run? Who in the business can run it? If something were to happen to me tomorrow, until we get to a point where we can sell or transact. Sometimes there's really old buy-sell agreements, and oftentimes family and shareholders aren't on the same page about where they want to go next, or when they want to sell, or how they want to transition the business. So making sure those conversations have been had and everybody agrees on the path forward. Then on the business side, it's really getting that credible financial information. If you can get a review or an audit, that is preferred, but a lot of deals happen on notice to reader. It's just with bigger companies, certainly there is that preference to have a higher level of assurance on your financial statements. Starting to gather it now, if you know that you have one-time items that you want or to fight to be adjusted out, or negotiate to be adjusted out is probably the better word. When you come to a transaction, save your evidence now, because doing that for years and years when you go to sell can be really hard. And start getting any personal items of the business now. Yes, for the most part, they would be adjusted out in a sale, but that takes away some of your negotiating power. And show that you have credible KPIs and ongoing monitoring. If nothing else, in the interim, banks love to see that these have been put in place, and it can really help with your lending until you're ready to sell. And what I think other speakers have talked about is making sure all your processes are documented, that everything is transferable to somebody else, and scalable in the process of transferring it. I'd like to see customer contracts in place so that the buyer knows that customers are going to buy for them at the same price that they buy from you. And if you have strong intellectual property, protect it, and also document it so that you can really get value for that. That really forms a big chunk of the goodwill valuation. I like to see that your people are engaged and that you have a strong workforce, and also supplier contracts. And also what we saw through COVID was a lot of supplier dependence, so that you have, supplier options and then contracts in place so that they know they'll get the same pricing. Business attractiveness, to no surprise, owner dependence is usually the #1 issue we deal with here. And by the time business owners see me, they are usually exhausted, overworked in the business, and don't know how to get themselves out of the day-to-day. So that's quite common. And then a quality management team behind them, making sure you have the people in place that would look good for a buyer. So this is really a form of, all of this is really buyer due diligence. Just put a buyer's hat on and think about what they would think about your business if they were to walk in. Long-term employee tenure is really good, and they feel like there's less risk of turnover. Strong, loyal customer base. Reoccurring revenues right now are in huge demand. We're seeing transaction multiples really increase for reoccurring revenue businesses. So this may be vets, doctors, dentists, things like safety that is always going to be there. Like you always need a fire extinguisher in your business, and you'll probably keep buying from the same person year after year. So businesses like that, the multiples are starting to really soar right now and are in high demand. Is your brand really strong? And one that comes up sometimes is your brand, your name. So some of our business owners, we slowly work to transition them to maybe using initials or other things, especially if they plan on living in the community where they have that business. They want to make sure, post-sale, people aren't coming up to them in the grocery store and complaining about the new owners or still thinking they are the owner. So sometimes having your name in the business makes it a little harder to transfer. You can clean up any lawsuits and really diversify your customers. Obviously one customer is pretty risky because if that customer goes and the business is essentially done. So the more customers you can have, the less risk. And really start thinking about where you could grow your business or those growth opportunities, especially if you don't have time to get into them. Like maybe you don't want to expand geographically because you're looking to sell quickly, but if you can explain the opportunities well in your SIM or other sales documents, that's really beneficial. So obviously there's a lot you could do there, and how do we prioritize it with the business owners? So the first one is de-risking the quick wins. These are usually the process documents, the contracts in place, and starting to remove dependence of the owner. Strategy, you can start looking at diversifying customer base, new markets, some of those things. And then efficiency is really how can we save some costs? We may look at a procurement program, renegotiating contracts. How can we operate more efficiently, doing some process work, some lean methodology to lean out the operations. And with that efficiency, then we may have some extra money if we need to hire another person on the management team to get the owner out, or we have money to fuel that growth phase. So if the business is looking to sell right away, we probably would get to maybe 3. If they want to hang on a little longer, 4 is where you really get into, like I said, tuck-in acquisitions, geographical expansion, or other things that may have a capital cost to them. And then the 5th one is culture. And the reason we do culture last, it's a tricky one to just throw money at. And this process, what it actually does, if you get really good at it and you keep working in those sprints and you keep executing and you keep showing growth in your business, you create a culture of relentless execution, which any buyer would like to see. So the process itself should hopefully improve the culture of the company and improve the accountability and the execution. But at that point too, there's other things that you could put in place, like maybe some extra benefits or community engagement or other things that may not have the highest payback or and might take longer to pay back. So as I said, a transition-ready business is a valuable business. So this work can be done at any point in your business. And the sooner you do it, the better. Like trying to clean this up after the fact is a lot more work than doing it right from the get-go. But no matter any business, there's some of this that exists that needs to be cleaned up. And I think some people are surprised at how maybe simple or non-revolutionary these topics are, or common practice or common sense, but they're not common practice in most businesses that we come across. And I would say that the businesses we target are that $5 million-ish. So if you are a smaller business, some of this still applies. Obviously, ensuring that your business can still pass on to someone else, even if it's only on you as the owner. How do you make sure that somebody else can come in and take over easily? And again, having some of these things documented is good regardless of the size of business. So if you would like to find out more or contact me, I'm active on LinkedIn. I post lots of articles and content there, and there's a lot saved under my profile if you want to find out more information. And again, I work with ATB Financial, which if you're not familiar with them, they're an Alberta-based Crown-owned bank. So we work with Alberta-based business owners and wealth clients. And you can contact me at avella@atb.com. So I will just look over to see if there's any questions with the few minutes we have left. If not, so let me just think a couple things maybe in the chat for you. So the first thing I'll throw in the chat here, We call this our pillar page, but it's meant to be a whole bunch of articles around succession planning. So if you need to brush up on tax or estate or how you do a business valuation, ways to exit a business, there's lots of materials there. We've tried to cover everything. We did some good Google Analytics to find out what people are searching with succession planning and make sure we have an article to address all the key areas. And then I'll also put sorry, my LinkedIn, so it's easy for you to connect with me on LinkedIn. And yeah, like I said, I share articles regularly about succession planning. I'll just do one last scroll through to see if there is any other questions. Okay, perfect. We have me on LinkedIn. Well, thanks everyone. I really appreciate you taking the time to hear the presentation, and don't be afraid to reach out. If I can help you, because I'm an Alberta-based business, I'm certainly connected with advisors all over the country and can help get you in touch with somebody that does this work in your area. Okay, thanks everyone. I don't know if Alex is on, if there's anything else I need to do, or I'll let you guys go network. Okay, perfect.
Hello?
Oh, hi, Alex.
Yeah, I just want to jump on and say thanks for your presentation. It was really great. Lots of great information. I just had a quick question, and maybe we can just kind of hop after. But if you had to give like one takeaway, or one, two, maybe three things, but you can just do one if you want. But just like one key takeaway that someone should get from your presentation, what would that be?
Yeah, I think it's that advanced planning, plan early. Get contingency plans in place to protect your family's wealth. That's what's heartbreaking to me when I see a family's wealth destroyed because there's no way to salvage the business. And again, that ties into that owner's dependence. If you can make sure that the business can operate without you in place, I get it may be a cost to have a second in command or somebody else that can really run the business, but if done right, you can find better ways to leverage your time on sales and other things that should hopefully, the payback should be there longer term, to have that extra resource to really help, make sure that the business runs day to day.
Yeah, definitely. Well, thanks for sharing that. And thanks again for your presentation. It was really great. So just to let everyone know, so our next session, well, it's the panel actually. It's on the main stage starting at 3:30. So about 3 or so minutes. So yeah, that'll be starting at 3:30. But thanks again, Amanda. It was really great having you back.
Great. Thanks for having me.
Yeah, no problem.
Okay.
Thanks. Bye.
Bye, everyone.